Good morning. This is Ken Long from Tortoise Capital with the review of the weekend trading report for September 7th, 2013. We have a market that's in bullish normal conditions on an annual basis using weekly RSI 14. It's at 59 out of 100. On a 10-day basis using the 10-day NDX, it's at 70 out of 100, so both are in the higher ranges of neutral. Looking at the market mosaic indicators, percent stretch relative to the 200-day moving average is 6.36%. That's back up to yellow bullish. Slope of the 50-day moving average improved to yellow neutral at 0.39%. ADX is still middle of neutral at 21.7. ATR percentage has increased to 1%, but still within the range of normal. The risk index, which is the 30 period moving average of the VIX divided by the 10, comes in at a reading of 0.89. So we are still in risk off conditions. The Z score of that reading, looking back 5,000 days, comes in at minus 1.41 standard deviations. You can see the time series of the last 90 days, and so we're at relatively extreme conditions for volatility. Excuse me. No change in the blended monthly rebalancing holdings. You can see it for the three different portfolios here. With the next reevaluation being due on or about 1 October, the theoretical exposure in ETF2 is at 30%. Model exposure, the model portfolio is at 80% exposed with stops in place. Just a quick look at the blended monthly portfolios, the 13 and the 32. You can see about half of them are on buy signals now. We still have U.S. tech and small caps in the 1 and 2 positions, followed by Japan and the internationals. The internationals have been making a pretty good move the last couple of weeks, so EFA has crept up into the lead, up into the top four now. On the 32 ETF portfolio, again, about half of them are on buy signals, still dominated by the U.S. Technology, discretionary, healthcare, small caps. Japan has snuck in, as has EFA, into the top 10. Most of that strength seems to be coming out of Europe as well. IEV doing very well. Looking at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back, all the way back to 90 days. The horizontal purple lines are price targets that have been resistance levels in the past. And if we get past them, then it makes the argument that the next one is in sight. We really have to see price above 171 to say the bull is back. The horizontal red lines are support levels that have held in the past. Excuse me. Dark blue shaded area is the 30 period Bollinger Band plus or minus 1, the river, with that red line being the 30 period simple moving average, the midpoint of the river. Lighter shaded blue area is the floodplain, which is the Bollinger Band plus or minus 2. This thick black line in the channel is the 30 period RAF regression line lagged by a day. The darker blue here that's a 10 period, and then the green one is the longer period, or the 90s. So now I'm looking at 90s, 30s, and 10s as long term, mid term, short term. And you can see that the long term is up. The middle term, the 30 had pulled back, and now the 10 has started to hook back up. And so that almost has a resemblance to a triple screen kind of buy on dip opportunities, which we see unfolding here. Support held at 163.5. Still inside that 10 period channel, and now we're testing the top levels of that regression channel on the 30. So if the shorter term recovery has some strength, it'll get through 167.5 here, get out of this channel, and then the next test would be 171. We're getting up into near to overbought conditions here on a Williams percent R10. And you can see that the jaws of PPO have closed to the downside and have now started to hook back up. I consider this space between the lower regression channel lines on the 30 and the 90 to sort of be a margin of safety, and here it is in the bottom half of the 30 period channel. So I see that as the cushion in the bull. That's how much fat the bull has on him to sustain him. But we're about ready to find out something here once we see this test around 167. Can it get through 167.5? If so, it's on the way to 171. If it fails here, then the next likely target would be down around 163 and a return back to the midpoint of the channel in this area. And it'd be more sideways oscillation after that. Quick look at the top 10 regions of the world market model. Two are in a cash. I did this. Oh, I'm sorry. I did this backwards. That should read 80% and 20%. That's you believe what you see, right? Or you see what you believe. And I have been bullish or bearish here lately. So that should read 80% invested and 20% cash. So if you're listening to this, you have special knowledge. World market model. We're seeing strength inside the U.S. and on the growth side, that's coming out of tech land. China backed off a little bit from the score of 100 from last week, and strength now beginning to come into Australia, Hong Kong, Taiwan, Korea. That's a change. That used to be all red. Everything Europe looking strong. Gold and silver have started to make a little recovery. Real estate suffering. Private equity continues to march right along here. Oil, because of tensions in the Middle East, continuing to outperform. Latin America and emerging markets still below average, although there has been some recovery here in the emerging markets. Basically, Mexico, Brazil, Latin America, biggies are all suffering. Looking at the top 30 ETFs in the big database, looking for new strength would be green in the strength column and white in consistency. So we'd see buyback achievers, the healthcare, small caps, Netherlands, healthcare, technology, small cap growth, small cap growth. Notice the pattern. The solar and the biotechs continue to do very well. Looking at the Dow 30 in the same through the same lens, IBM is the weakest. United Health is the strongest. Cisco is giving back. Gave back some gains, and now that could be a buy on dip opportunity because it's green on consistency and white on strength. So a rebound there to put it back up near the top of its game and near the top of the Dow would be a nice rebound trade, especially as technology has been doing very well. Same with Hewlett Packard. Both of those have been showing up on our max pain range compression um, target lists. And just some liquidity factors. We'll now take a look at shift to the daily report. We've got some short signals in the overreaction system for Asia, less Japan, Latin America, and emerging markets. Channeling an overreaction in Microsoft and Home Depot here, 551W in gold, and then in the auto framer, Microsoft gold, silver treasuries, and the inverse VIX. You can see that on using ADX that the bears are still in charge, and that volatility has returned to the 6-month mean, right around 1%. Very few patterns in the Dow. Microsoft standing out as a single digit on RSI2 with the 10.5 to 1 max pain range compression ratio in the auto framer. Home Depot also coming in at single digits. It's down almost 8% in the last month and is a channeling signal. So that would be one to worth looking at. Looking for one-day momentum plays. Caterpillar, Hewlett Packard, J.P. Morgan, and McDonald's all were exceptional winners on Friday. Hewlett Packard ought to be interesting because it was a big day up for them, 1.5%, and they're down 16% over the last month. So that's the very definition of a buy and dip opportunity. In the ETFs, just a couple of dojis, a 551W in gold, which tests out at 2.6 to 1 in the auto framer. The inverse VIX ETF 2.2 on the auto framer. Nothing triggering on RSI2. Silver, real estate, and gold all had good days. Are these one-day pops here in emerging markets in Brazil and Latin America? Don't know, but they've been beaten down for so long that there may be some value plays available there. Auto framer, just a handful. Microsoft at 10 to 1 looks very interesting. Gold, silver treasuries in the inverse fix round out the ones that are better than 2 to 1 on the reward to risk ratio in the auto framer. Nice little recovery here in the S&P over the last 6 or 7 days, have brought it back above the regression line. The regression line steepness is starting to recover now. It's getting ready to cross its 10-period moving average after a 2 standard deviation move below the 6-month average. And this is the last place that it recovered the last time it was down here and then resumed. It went from 6% above the 200-day moving average to 12%, so there's a 6 to 8% move available to the upside. That would take it above 171 if that full move manifested. And so that's the potential on the upside. And the rest of the chart, I'll just flash through for you to stop and look at it at your leisure, but no additional commentary. Until we get to here. I would say that the finding support at the river is what this is looking like. That's the last time that it fell out and then resumed. The last time it went to 171, and that's the presumption on the possibility for the upside here. Failure here, however, takes it back to 155. You've got the 30 has fallen all the way out of the z-score channel right here, plus or minus 1, and has started to reverse back up. The 10 found support at -2 and is now above average. The 90 has pulled all the way back to its long-term 6-month steepness average, and so this is the posture for a nice resumption. It's found some basing activity over the last 20 or 30 days, and that's the technical argument for an upside move. I would just say, notice that in each case, each one of these dips that came down, this one didn't even get to the bottom of the river and sharply reversed. This one took its time before reversing. This one took even more time to reverse, and it was harder to get out of the river. This one failed below, but then rebounded nicely, and this is the longest price decay that we've seen. So that looks like an aging bull, sort of the life cycle of man, if you will. Um, So it's getting harder and harder to believe in that. However, this is a nice base, and 6 to 8% move to the upside is certainly not out of the ordinary. This is that nice rebound in gold, which happened while the S&P and the small caps were suffering. Treasuries have done nothing. Down, pulled all the way back from, used to be up around 130, is now back to 105. That's your risk-free rate of return right there. Frog stats, range stats, gap stats. And that's everything I want to cover. We're off to our soccer tournament. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.